Good afternoon and welcome to your Lockheed Martin Retirement Pension Maximization webinar. Sorry about that, guys. So today's webinar is talking about your retirement pension maximization and how not to miss out on what you are entitled to and to get every last penny you can before your retirement clock countdown begins and you know you have one, and we don't want it to get to zero without you knowing everything you need to know. So let's go over our disclaimers for today. So today we have general disclaimers for you because today is informational purposes only. This is not intended to be any specific advice for your specific situation or tax advice or legal advice. We do suggest you talk to your qualified licensed professionals in those areas when it comes to your specific situation. So who is Strittmatter Wealth Management Group? Well, guys, we are a registered investment advisory firm that was established back in 2007. We're a group of financial planners and fiduciaries that go over multiple things with our clients in the planning phase, whether it's retirement planning, investment management, estate planning, real estate investing. And we have a slew of advisors. Our top three are Josh Strittmatter, who is the CEO. He is a personal wealth manager. He's been doing this since 2007 when he started Strittmatter Wealth Management Group. But before that, he worked at Ameriprise from 2002. He has a bachelor's from UT Arlington and, of course, holds his CFP and CRC designations. He does specialize in complex planning for high net worth individuals and business owners. I am Kelly Boofink, your presenter for today. I am our branch manager as well as a personal wealth manager. And I joined Strittmatter Wealth back in 2018. Prior to that, I was the director of the national branch and an advisor at First Command Financial Services since 2001. I have a degree from the University of Maryland, University College, and I specialize in estate planning, retirement planning, investment planning, protection planning, and veteran benefits. Corey is our other CFP and also personal wealth manager. He joined us in 2020 after he graduated from the Texas Tech University, summa cum laude, with his degree in financial planning and minor in sports management. And he specializes in investment management, retirement planning, and risk management. Let's go over our course outline for today because we'll be covering 6 important areas. First, we're going to talk about the past changes that Lockheed had. Then we're going to go over your pension, how it works, and the specific strategies you can use. We'll also talk about the ins and outs of your 401k and strategies for it as well. We'll go over your healthcare options upon retirement, your insurance benefits, and what you can take with you into retirement. And we'll review the list of top 10 mistakes to avoid. And finally, we'll wrap it all up. So let's begin with the Lockheed Martin retirement changes. So all of you are probably well aware now of the changes to your pension plan and the aspects that it all has been frozen. So the pension was closed to new employees starting in January of 2026, and all of your pay elements under the plan were frozen as of December 31st, 2015. Your credited service accruals were frozen as of December 31st, 2019. So there's no way to further increase your pension benefits at this time. Now, when the pension was frozen in 2019, the retirement savings program also underwent a change in conjunction with those pension changes. As of January 1st, 2020, employees receive an automatic 6% contribution into your savings program, which is up from the 2% that was in the past. Therefore, if you're funding your 401k with at least 8%, then the total Lockheed Martin is contributing to your overall savings is 10%. 6% from the savings plan and 4% from the 401k match. Well, let's start with discussing your pension. So what is a pension anyway? Well, it's considered a defined benefit plan that will provide you a specific monthly benefit or income upon your retirement from the company for eligible employees. It's not for everyone. Your pension does not have a cost of living adjustment to it for inflation purposes, so it will remain the same for your entire life. Now, there are various ways to calculate a pension. Some companies use a formula that's based on salary and years of service, whereas others may have a specific stated dollar amount. Your pension has a very specific formula that we'll review in a bit. Now, if you're eligible for your pension benefits after 5 years of vesting service or age 65 years old, whichever comes first. At Lockheed Martin, you'll have both the 401k plan, which is known as the defined contribution plan, and the pension, which is known as your defined benefit plan. So let's review the details of your 401k plan first. The benefits are based on amounts contributed plus or minus any income, expense, gains, or losses. It provides you an individual account, which you can see the details of your statements from Empower. You and your employer may contribute to your account. Again, Lockheed will contribute 4% if you're contributing 8%. So they match 50% of whatever you are doing up to 8%. And we'll get into that a little later. The contributions may be based on a percentage of your salary and or related to the years of service. Yours is actually based on a percentage. And you're responsible for your own investment selections. The dollars withdrawn from your 401k are taxed as ordinary income at your regular income tax brackets for pre-tax contributions, and only the gains on post-tax contributions will be taxed as ordinary income. Now, because this is a tax-deferred savings plan, there is a mandatory distribution that will begin at age 73, and it's based on the IRS Uniform Lifetime Tables. So let's compare that to your pension. So your benefits are based on a calculation using your years of service, the Social Security breakpoint, average income, and accrual rate. Participants may or may not be required to make contributions to the plan depending upon how it's set up. And so with yours, you are not required to make any contributions to it, and you are also not required to make any investment selections. They make those for you. Your income from the pension benefit in retirement will be taxed as ordinary income, and you must begin taking your pension no later than age 73 if you are retired. So then what are the advantages and disadvantages of the defined benefit plan, otherwise known as your pension? Well, the advantages are quite a few. Lockheed Martin is responsible for providing you the retirement benefit. You'll know the benefit amount in advance as you request it online. It doesn't depend on your ability to save to it. There's no investment risk for you. The assets are managed by professional money managers. There's no tax-deferred retirement savings. Now, some offer a cost of living adjustment. However, yours does not. So that's something to consider when you're planning, because you'll probably need to subsidize your income from your investments to keep up with inflation. It is insured by the PBGC, otherwise known as the Pension Benefit Guaranty Corporation, meaning that if Lockheed went out of business, the PBGC would then come in and continue to pay a portion of the benefit, but not all of it. So when we have advantages, of course, we have disadvantages. So disadvantages are that there is not an individual account established in your name. It may provide for only a portion of the income needed during retirement. It can be often difficult to understand due to a complex formula. It usually doesn't benefit those who leave the company before retirement because either it's reduced or there's nothing to take with them if they're not vested. And the benefits are typically not paid out until normal retirement age. Now, most plans don't allow for a lump sum payment at retirement, but rather only a monthly payout, and that's what yours is too. So how is your pension calculated? Well, it's based on 4 factors. Your final average pay is 1. Then the Social Security breakpoint is next. The plan's accrual rate and your credited years of service. So those are the 4 factors in which to calculate your pension. So Lockheed's pension uses the final average pay of your highest 3 years during your last 10 years, starting from 2015 and going backwards, because that's when the portion of your pension was frozen on December 31st of 2015. Now, those 3 highest years of pay do not have to be in consecutive order. So you can take those top 3 years and then add them together and divide by 3 to find the average, just as the example shows. So in 2011, this person in the example earned $66,000. And then 2012, for some reason, they didn't earn as much. Maybe they weren't getting their locale pay anymore. Who knows? But in 2014 and 2015, there was a pay raise again. So we take those three highest years, add them up, divide by 3. That gives us 67,666. So that's the first factor in determining the pay or the pension. The next factor is the Social Security breakpoint. The Social Security breakpoint is the average of what's called the Social Security maximum wage base, meaning it's the income limit on which you pay Social Security tax. It's an amount that's published each year and indexed or increases each year. For each of you, it's based on your birth year, and it's calculated as an average over a 35-year period, which ends with the last day of the year in which you reach normal retirement age for Social Security, which for most of you is going to be 66 in some months, or 67. And the break point will be based on the table that's in effect when you retire or you quit working. So that's number 2. The third one is the accrual rate. The accrual rate is the factor that's applied to your final average pay and used to determine your benefit. Lockheed Martin has a tiered calculation formula. Your final average pay up to the Social Security breakpoint times 1.5%, then times your accredited service up to 35 years. Okay, so that's step number 1. Then you add that to the next level, which is your final average pay over the Social Security breakpoint times 1.5%, then times your accredited service up to 35 years. So that's number 2. And then you add that to the last level, which is your final average pay times 1.5% times any credited years of service over 35 years. So when you add all that up, that gets you your accrual rate. But let's look at an example to break it down. So in this example, we have a 65-year-old who is retiring with 20 years of credited service. We assume the final average pay is $125,000. The Social Security breakpoint for someone born in 1959 is $99,720. So in step 1, we multiply that breakpoint by 1.25%. That gives us $1,247. Then in step number 2, we multiply the income over the breakpoint by 1.5%. And that gives us that $379. In step 3, we multiply those two amounts below and above the breakpoint by the years of service. Okay, so that gives us an annual benefit of $32,520, or divided by 12, monthly is $2,710, based on your life only. So your pension only paying you up until you pass away. Now, do you have to do it that way? Absolutely not. So you actually have a choice of various options on how to distribute your pension and to take advantage of what's called a survivor benefit. So these are the amounts that you can see on your benefit estimate from which you can choose. So there is a single life only option, which means that the pension would pay out the highest benefit, but only while you are alive. So as soon as you pass away, the pension benefit is going to stop, with nothing further going to your spouse or your heirs. Now, the second one, sometimes the most common one, is what's called the life and survivor, or joint and survivor, at 100%. So this is the option which lowers your pension benefit. However, when you pass away, 100% of the full benefit will continue to pay for your surviving spouse. So this one provides you the least amount of everyday income because it's paying over 2 lives, but it's the only one that guarantees 100% of your income to continue on to your spouse. The third one is the life and survivor at the 50% option. So it also lowers your pension benefit from that single life only, but not as far as the 100% one. Because when you pass away, you're only leaving 50% or half of your retirement benefit that you were receiving to your spouse. So if you get $2,000 a month as a pension and you elected the 50% survivor, then your spouse will continue to get $1,000 after that. So half of it. There's also what's called a pop-up provision. This accompanies any of the survivor options. Okay, so what this provision states is that if your spouse passes away first before you, but within your first 5 years of retirement, then your pension amount, the benefit that you're receiving, will automatically pop back up or increase back up to the single life only amount. So then you continue to get the highest amount of pension payment. But that's only if your spouse dies first within your first 5 years of retirement. After that, if your spouse should pass away, then you remain at that lower joint benefit payout for the remainder of your life. So it's very important for you guys to make sure that you have evaluated all of your options carefully before you make your election. Once you make your election, you can't go back and change it. So with your joint and survivor payout options, you're basically purchasing a life insurance policy from your pension plan. Because when you die, they're guaranteeing that your pension income continues to your survivor. The risk with the joint and survivor options is if your survivor dies before you after year 6. At that point, you're locked into that lower monthly pension benefit that we just talked about. So, as an alternative to this strategy, you can consider purchasing your own life insurance policy, which may offer better rates and benefits, and it can enhance the pension annuity option that you select. So let's talk about that strategy that can help you with your pension benefits. It's actually called pension maximization. In this example, we have Bob and Julia. Bob is considering either electing the single life only option or the joint and 100% survivor option. So as you can see on the screen, the single life amount is $2,875 per month, whereas the joint and 100% survivor is $2,010 per month, which remember, that's reduced because it's paying out over 2 lives. So the difference is $865 a month that you don't receive, but rather you pay the life insurance that guarantees your survivor's income. So here's how it works. Let's use Bob and Julia as our example. Bob would choose the single life option and then use the extra income, that $865, to purchase a personal life policy. If the policy costs less than $865, then they have increased their monthly benefit while Bob is alive. In addition, if the policy provides a death benefit that generates more than $2,010 per month of income for Julia after Bob dies, then they've also come out ahead. So what Bob and Julia are looking for is a policy that costs them less than $865 per month and will provide a death benefit income of either $2,010 per month or more. But what happens if Julia dies first, guys? Well, Bob has options. Depending on the type of policy purchased, he can cancel the policy, ending the premium, and continue to receive the full single life only benefit of $2,875, or he can keep the policy in place and change the beneficiaries or access the cash value. The point is Bob has full control and flexibility to make those decisions should he need to. Well, let me give you a big flashing warning right here, okay? It's very important to look before you leap when you're making your pension decisions. So what does that mean? That means Bob and Julia should first find out if Bob even qualifies for a life insurance policy based on his health, along with the cost and benefit of that policy. Because if Bob should buy that policy first, he needs to also make sure that it's issued and enforced before making the final pension payout decision. Because what could happen if they make the decision to not take the survivor on the pension and then he applies for the life insurance policy? That's right. He could not be insurable, meaning he can't get the insurance and now he's locked into the decision he selected. And then Julia might just be up the creek with no survivor pension to rely on in the future years. So it's very, very important. If this is something you're going to even want to consider, you do it before you make any pension decisions. So how would Bob and Julia even decide or know what they need if they want to use the pension maximization strategy? Well, first and foremost, they would need to talk to their advisor or us, somebody who is very familiar with how to do pension maximization correctly. They would need to be somewhat familiar with the calculation as well. So let's take a look at their numbers in this example. You see lots of numbers up on the screen. Both in this example are age 60, and they're expected to retire at age 65. So we're giving Bob a life expectancy of 89 and Julia at age 90. So the single life pension we already know would provide Bob $2,875 a month as a benefit, whereas the joint and 100% survivor would provide the $2,010 a month benefit. Now the benefit is not indexed for inflation. The cost of the joint and survivor benefit is the difference between those two numbers, that $865. In his first year of retirement age, at age 65, is $322,171. Now, that's the lump sum amount he would need if he died in that first year. But if he died later at age 89, he only needs $45,425. Now, the future value of Bob's overall savings, if he used this method, is $510,365, and his break-even age is 65. So he must at least live that long. So shouldn't be too hard to do. But let's look further into the details. So we can see what lump sums are actually needed. So the chart is pretty small on your screen. If you can blow it up, that's great. Otherwise, this is of course being recorded, and you can see this in a replay where you can pause it and blow up the screen. But we are looking at the fourth column over to the right, or second column back to the left. It says lump sum required to replace the pension. Okay. So in year one, at Bob's age 65, the lump sum required is $322,171. Now, if we follow that column down, we can see that the lump sum figure is steadily reducing. That's because Bob is getting closer to his life expectancy of age 89, and it takes less to replace the pension because there's less years in which to provide the income. So Bob could use these figures to put in place the pension maximization strategy and buy his own life insurance policy. Now, there are a couple ways to put this strategy in place. One is by using cash value or permanent life insurance. Now, it's permanent because it's designed to last your entire life until death or cancellation. This is the recommended type because the insurance will not expire prior to your death. A term policy is not a good solution because it may expire prior to your death, because term policies are usually 10, 20, 30 years, and that's it. The second strategy is to use a combination of both that term and permanent insurance, because that might allow you to pay less overall in premiums than if you purchase the cash value only policy. So when you use a combination of the strategy, both a 20-year term policy and a permanent life policy, like your Lockheed Martin's GUL, Guaranteed Universal Life, would be purchased. So to calculate the 20-year term death benefit needed, Bob would subtract the 20-year need from the year one need. So let me go backwards. So look down here at year 20, and then subtract that from year number one. And that's what gave us the difference between the two. Okay, so in that example, the first year was the $322,171, and the 20-year number was $121,833. The difference between those two is $200,338. So $200,338. This would be the amount that Bob would need as his 20-year term policy. Okay, the 20-year lump sum of that $121,833, that would be the amount we need for the permanent policy. So when these two work together, the term policy expires at year 20, and then that only leaves the permanent policy in place. Therefore, it reduces the total premiums paid and increases your cash flow. And if the permanent policy allows, then you could further reduce that death benefit each year to match the lump sum needed. At the same time, you'd be further reducing your premium. So how much does Bob actually have to pay for this strategy? Great question. Well, his permanent policy would cost $31.98 a year, if he insured the entire amount from year one with the permanent policy. But if he used the combination strategy, he'd pay $11.44 annually for the term and $13.89 for the permanent policy, giving him a total annual premium of $25.33 per year or $211 per month. So this gives him an annual savings of $665 by using that combination strategy rather than the pure cash value strategy. He also gives himself a monthly pay raise of $654 by using this strategy. See, to figure that out, we took that $865 a month survivor cost, multiplied it by 12, giving us the $10,380, and then we subtract out the insurance cost, which is $25.33. That equals $78.47 per year, or $654 per month. All right. Now, there is a chat section in Zoom, so if you have questions, please type them in, and at the end, we'll go ahead and look to see if anybody has any questions there. Okay, now we're going to switch gears, and we're going to talk about your 401k. So Lockheed Martin, as you know, matches your 401k. It matches 50% of the first 8% of your contribution. So you want to be sure to be contributing at least 8% so as not to leave any free money on the table. You are eligible to contribute up to $23,500 for 2025. Now, you have a special catch-up contribution if you're between the ages of 50 to 59 or 64 and older. You can put an extra $7,500 a year into your 401k. And then a super special catch-up contribution is if you are between age 60 and 63, you can put in $11,250 a year, in addition to that $23,500. Okay. You also have the option to contribute either pre-tax or post-tax or Roth portion of your plan. And due to the Secure Act 2.2, any other catch-up contributions going forward will be required to be invested into the post-tax Roth portion of your 401k if your wages are above $145,000 starting next year. And that $145,000 will increase and be indexed for inflation. So, with your 401k, the company match part didn't change. They still match 50% of your first 8% that you contribute. Meaning you put in 8, they put in 4. You put in 6, they put in 3. You put in 4, they put in 2. I think you get the picture. Now, what's special about Lockheed is that they also allow you to contribute more than the actual annual maximum to your 401k plan. You can contribute up to 40% of your base pay. Now, the rule is that the maximum is the lesser of 100% of your compensation, or $70,000 if you are below age 50, or $77,500 that include the catch-up contributions if you are between age 50 and 59 or 64 and older. Now, for those of you who are in the 60 to 63 age window, you can actually contribute a total of $81,250. And that's great for you because this allows you to invest well more than the IRS limit of $31,000. That $31,000 includes the catch-up contribution for other people not working at Lockheed. Now, once you guys are 59 and a half and you're ready to make an in-service or retirement rollover, your dollars would transfer out of your 401k. And your post-tax balance of your 401k can be directly rolled into a Roth IRA. So when you roll your account, you actually receive 2 checks from Empower if you have saved to both the pre- and post-tax buckets. So the pre-tax dollars would be rolled into the traditional IRA, keeping the same tax-deferred growth benefits, and the post-tax dollars would be rolled into the Roth IRA, keeping the tax-free growth benefits. And of course, Roth contributions also go directly to the Roth IRA. So it's really important to make sure in your 401k, not only are you contributing or the amount that's needed to reach your goals, but also to make sure that you have your beneficiaries listed on your 401k and that they're current. Because your 401k is considered a direct transfer asset. What that means is that your 401k avoids probate when you pass away and transfers directly to your beneficiaries. So you'll want to make sure you have both primary and contingent beneficiaries listed. So your first choices and your second choices. And even if you have a will in place, whatever you have listed on your 401k overrides what's listed on the will. So side note, just be sure to go back and check those. Now, if you're like most other employees out there at Lockheed, then you probably own some Lockheed Martin stock, okay? And you probably have that in your 401k. Some own more than other people do. Now, there is a strategy called net unrealized appreciation that will help you transfer your stock out of your 401k and into a non-qualified, a non-IRA account. It allows you to pay tax on the transfer at long-term capital gains rates rather than ordinary income rates, which can possibly save you quite a bit depending on your tax bracket. Now, this strategy doesn't work for everyone. So you want to make sure you talk to a financial planner, tax advisor about this before you make a decision to make the move. So let's talk about some other great benefits you have as a retiree. One is your medical insurance plan, okay? So you have some really good medical insurance plans that some employees can take with them into retirement. Your enrollment may begin either at your retirement or when your pension plan begins. So the coverage might be different though than your current coverage. So definitely check with your service center first to go over what those details are. They can provide you quotes on the retiree amount of coverage. You also have the ability to supplement your Medicare through the VIA benefits site that you have access to. So you become eligible for Medicare and for the supplement when you are 65 years old. So typically you should start shopping and enrolling about 3 months prior to your 65th birthday. Lockheed may even provide you a subsidy to help offset some of that cost. However, you must be enrolled in both Part A and B. And you must enroll through VIA benefits or have TRICARE for life to be eligible for the subsidy. Now, if you choose to enroll later rather than when you first turn 65, you will still be eligible for the subsidy benefit. Because if you're still working, there's no reason to apply for Medicare yet if you are covered under the other insurances. So another great way to help offset your medical expenses is by investing into a health savings account. If you have a high deductible health insurance plan, then you may be eligible to have an HSA. An HSA is an account in which you can save pre-tax dollars that can be used at a later day to pay for medical expenses and medications. The IRS does have contribution limits on the account, though. They are $4,300 for a single person and $8,550 for a family. And if you're over age 55, you can also put in an additional $1,000 as a catch-up contribution. So what's really great about this account is that when the dollars are used for medical purposes, there is no tax on the money when it's distributed. So money goes in, you deduct it from your income, you don't pay tax on it. You pay for medical purposes that are qualified. You don't pay tax on it when you pull it out. So it's awesome. Some other great benefits is that you don't pay any FICA tax on those contributions. And when you retire, those contributions are yours to take with you. They cannot be forfeited. You also have options on how to invest those dollars. You can leave them in savings accounts, or you can invest them in the stock market. So once you enroll in Medicare, you can no longer make contributions to your HSA. So be very aware of that. But you can still use the dollars for your medical expenses. You can even withdraw the dollars for non-medical expenses. Just know that they will be taxed as ordinary income, just like a withdrawal from an IRA, if you're not using them for qualified medical expenses. Now, one of the greatest benefits you have as a Lockheed Martin employee is the ability to take some of your insurance coverages with you into retirement. So some of the policies that are eligible to transfer are your term life, your universal life, your special accident coverage, dependent term life on your spouse or children, any supplemental medical, your long-term disability, and if you were lucky enough to have the ability to elect it, the long-term care. So when you transfer coverages like these into retirement, many of them don't require additional proof of insurability. So that's really great news. Now, if you are wanting to transfer and increase some of your coverages, though, in retirement, you may have to have that proof of insurability, meaning there would be some medical questions and some other things you would have to go through. So if you know you want more than you currently have, and you still have another open season coming in October, well, then an open season on October, get as much as you can on your insurances. That way you already have it in place for when you retire. It'll just pass along with you. Make sense? Good. Okay. Don't forget, ask questions along the way and we'll cover them at the end. So, as promised, this is going to be kept short. We'll wrap up with our top 10 retirement mistakes for you to avoid. First and foremost, not taking any full advantage of the 401k match. Please don't leave any free money on the table. Not taking your vacation and then retiring. One strategy many of our clients like to do is they will use their PTO to start taking maybe 1 day a week off, getting used to transitioning into retirement, then 2, then 3. Otherwise, you retire, you have all the vacation, and then it's all paid out to you in one lump sum. Mistake number 3, not using the pension maximization strategy. Again, even looking to see if this is right for you or not. You don't know until you've gone through the numbers. So you want to make the best choice that you can for your family and maximize the amount of pension that you can receive. Number 4, not using the post-tax portion of the 401k to save more money. Not rolling your post-tax portion of your 401k into a Roth IRA. When you get those 2 checks from Empower, you do need to make sure that you're very careful on how you invest those, because you don't want to accidentally put the post-tax portion in a traditional IRA that was pre-tax. You want to keep that taxability the same. Number 6, not naming a beneficiary of your 401k. Number 7, not taking advantage of the net unrealized appreciation for your Lockheed stock if it is right for you. Number 8, not using the healthcare Medicare benefits that you can get through VIA benefits and also receive the subsidy. Number 9, not saving the maximum to your HSA. And number 10, not using Lockheed Guaranteed Universal Life Insurance. And just as a bonus, not using Strittmatter Wealth Management Group to plan for your retirement. So, what are your next steps? You've taken the time, you've listened through this webinar, hopefully learned a lot of information. So I suggest you start gathering your own information. Read your summary plan descriptions to get a better understanding of the details of all your benefits. Write down what your objectives are and any questions you have based on what you've learned today, and then take action. And you can actually request a complimentary consultation to start or continue your retirement planning and see if the pension strategy will work for you. So who is Strittmatter Wealth? Well, we are a registered investment advisory firm, meaning that we are a fee-based firm. We have all the tools and products available for our use to ensure that we're making the best recommendations for each client. And we're not limited to a smaller selection like many planners under a broker-dealer. We specialize in comprehensive financial planning, where we investigate the details of your retirement planning, tax planning, estate planning. We also manage our clients' assets using the nation's top institutional money managers and their models. And of course, if insurance is needed, we can provide that as well through our independent insurance agency. If real estate investing or property management is needed, We also have a sister company that we can do that. In addition, many people like to start up their own businesses in retirement. We have a business brokerage service where we can help you purchase a business, or you start the business and decide to sell it. We can help you do that as well. So when I say comprehensive, I mean comprehensive. And we'd love to share more with you, so go ahead and request your consultation to learn more. In addition to today's educational webinar, we have other ways to learn. Education is very important to us. You can visit our website to see our Lockheed Martin blog. You can also sign up for our weekly or monthly e-newsletters. And if today's webinar, you have learned more than you thought, or you've learned anything, we'd love to see you in some of our other classes, which are taught at the local universities. And those are 3-hour classes. So there isn't a more wealth of information there. All the dates and locations can be found online at strittmatterwealth.com. And of course, if you'd like us on Facebook, you can receive information about future classes and events there too. I do have a special offer for you today, having just been in this webinar. So for attending today's webinar, we're pleased to offer you a complimentary 401k analysis. This includes reviewing your existing portfolio and showing you ways to improve your performance, reviewing your investment risk to minimize unnecessary losses. You'll also receive personal recommendations on how to invest to maximize your growth over time. Now, this report is valued at $500, but for today, until 5 p.m., it's free for you. And that is a limited time offering for today only, since you attended the webinar. Now, if you are looking at your pension and that's more important to you at the moment, you can also receive a complimentary pension maximization analysis report. This will determine which strategy is right for you: life only, joint survivor, or doing it yourself with the full pension maximization. So we'll determine the amount and cost of insurance needed, as well as putting in place a plan to get the most out of your pension. That report is also a $500 value, but free for you today. So how do you get these reports? Well, you need to schedule a meeting, and you can scan the QR code on your screen to schedule that complimentary analysis report. Again, this offer is only good till 5 p.m. today. And once you scan this, you'll pick a date and time, and that will book you with either myself, Josh, or Corey, the 3 advisors we went over at the bottom, at the beginning of the meeting. So while you're taking a moment to scan, I am going to take a look over at our chat box so we can answer the questions as they were coming in. And of course, you'll be emailed a copy of today's webinar. Okay, so questions. Oh, we do have quite a few. Okay, first and foremost, when can I transfer my 401k, and how does my Lockheed stock transfer? Great question. So you can transfer your 401k while you are still working if you are over 59.5 years old. Okay, that's called an in-service rollover. If you are about to retire or you've already retired and you still left it there, you can still move it too. The way the process works, like when we do this for our clients, our operations team will actually call Empower on the phone with you and go through the details. They'll get the amounts that are eligible for transfer. If you're still working, sometimes you have to leave some money there. It just depends on what's in there, when it came in and such. They will issue 2 checks, one pre-tax, one post-tax dollars. Those checks get made payable to the custodian that holds the account, and they are mailed to you. You then send us the checks, we deposit them into your new IRA accounts, and they are good to go. Now, for your Lockheed stock, you have 2 choices. You can liquidate your stock and invest that in cash, or the Lockheed Martin stock can do what's called transfer in kind, where it stays just as it is, and all it does is move accounts electronically. Okay. Okay, second question. When is the best time to make the pension decision? Okay, so like I said earlier, the best time to make that pension decision is before you retire. Does that mean it has to be within 6 months? No, the sooner the better. Because if you do decide to use the pension maximization strategy, well, the life insurance cost is based on your age. So the younger you put it in place, the less expensive it will be, and that cost gets locked in so it can't increase. What if I want to increase my insurance while employed? Open season. Okay, that's when you go through. Now, if you have a qualified life event, you got married, you had a child, anything of that sort, you can also have an option to increase your insurance, but most of the time it's open season for you. Mm, does the Lockheed Martin insurance cost the same when I take it into retirement with me? Great question. Depends on which insurance you're talking about. If we're talking about the guaranteed universal life insurance, then no, actually. That one is on a tiered schedule, meaning at certain ages that cost will increase. So from age 50 to 55, 55 to 60, 60 to 65, and age 70 and plus, those are the brackets where the cost will actually increase. Now, once you are over age 70, though, that's when it locks in and it no longer increases. Great question. Is there a cost to meet with you? No. No cost to have a complimentary consultation. Now, from there, if you decide to do business, depending on the type of business you want to do with us, comprehensive planning, investment management, things of that sort, we are fee-based, like I said before. So there is a structured matrix we can go over with you and tell you exactly what that cost would be. And then last question, it looks like, how soon can I have a meeting and would the meeting be with you? The meeting may or may not be with me. It depends on the day you select. When you just scan this QR code that's up here on the screen, you pick the day and time, and then that'll see who's available. It'll either be myself, Josh, or Corey. But if you do have a preference with Josh, myself, or Corey, you just let us know. You can give us a call at 817-210-3444 and talk to our scheduler, Tamara, and she'll be able to fit you in on the calendar. Okay. Are there any more questions? Okay, doesn't look like there's any more questions. Well, you guys have a wonderful day, and we hope to see you soon.